We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Luke Gromen, founder and president of FFTT, or Forest for the Trees. Luke, thanks for joining me today. How are you?
I'm doing great, Tom. It's great to be back here. Thanks for having me on. How are you?
I'm excellent. It's always a pleasure to speak with you. I always really look forward to it because we don't necessarily talk all the time, but it's always a really enlightening and thought-provoking conversation. And
thank you.
We have a ton to go over today and trying to figure out where all of these pieces fit. And I think the best place to kind of start is to talk about obviously the tariffs right now. You know, that has thrown the world economy, the trading partners, markets, all of these different pieces of the puzzle that we care about into the air. And so maybe we should start by talking about how China has started to react to the tariffs. You know, I've seen reports recently that Chinese workers are now protesting, and there has also been a quiet exemption of US goods that had originally had tariffs imposed on them. So does this mean that Trump's strategy is starting to work by putting pressure on the Chinese economy?
I think maybe on some level. Clearly, in my view, it's a case of mutually assured economic destruction. I saw something on Bloomberg the other day that showed that China had exempted, I want to say 20 or 25% of the tariffed stuff they had put tariffs on. Mm-hmm. And, the interesting thing within that Bloomberg graph was that the U.S. had actually exempted about 30 or 35%. So quietly, we'd exempted more as a percent of what we bring in than they had. But I think both sides are hurting, and I think we're getting to a point in the negotiation, where you're starting to see those stress points. The one you related about China, obviously, and I think we're going to get, there was a story in Rolling Stone the other day, take it with a grain of salt, from, quoting senior Trump officials that they and their families are stockpiling goods because they know shortages are coming in the United States of America. So it's setting up for, the more unpleasant parts of that mutually assured economic destruction if we don't get a deal done. And so, it makes for, like you said, the pieces are still sort of in the air.
So, Luke, what do you think was, let's say, the catalyst for Trump to implement this 90-day ban or pause, on the tariff structure that he had presented? Could it be that the Treasury market forced his hand in this respect?
Yeah, I absolutely think it did. And he and Bessent both came out and said it was not the bond market that made us do this, which is, what is the old famous saw about, never believe anything until it's officially denied. Ultimately, the metaphor we've used a number of times has been a boxer or MMA fighter with badly broken ribs. And the badly broken ribs, if the other fighter knows about it, are a weakness that are going to be exploited. And the badly broken ribs in the U.S.'s case has been and continues to be the bond market. And we were very vocal, really more on Doge than the tariffs, but obviously we saw the reaction from tariffs, but that the United States needed to follow an order of operations that was devalue the debt to GDP first, a number of different ways you can do that, and then go about trying to cut spending, or in this case, with aggressive tariffs. And we did the tariffs, we didn't devalue the debt first, and the Treasury market started severely dysfunctioning within 10 trading days, maybe. And severe dysfunction, the move volatility index was, I think 172 intraday. Anything over 135 has been met with liquidity going back really 4 or 5 years. So I do think it was ultimately the Treasury market that forced the Trump administration's hands, because what was starting to happen is you're getting a situation where you're going to have rates up dollar down, stocks down, rates up. That's a debt spiral, and that's not something that can be withstood for very long by anybody. And it's not, to be clear, it's not good for the rest of the world either. It's just basically an unwind of the entire system. So, yeah, I think it absolutely had very much to do. And there was an article discussing exactly that in the Wall Street Journal a couple weeks back, where Bessent and Lutnick basically, sent Navarro on on what we used to call a snipe hunt, right? And in the White House, right? Hey, go find the snipe on the other side of the White House. Of course, there is no snipe, and so Navarro went looking for the snipe, and Lutnick and Bessent went to Trump off and said, "Listen, you gotta pause this. This is insane. Where you're upsetting the markets." It was a Treasury market, in my opinion.
Mm-hmm. So, Luke, when we think about basically what's happening right now and what this could mean for, let's say, the US particularly, just in this context, this trade war is seemingly, let's say, expanding right now. And I've seen charts and reports like the one I just put up of a 40% year over year negative change in containers coming from China. So is it possible that, going into the summer, maybe even for the next year, we're going to see higher inflation, shortages, as you mentioned, and more political disruption because of, let's say, the negative effects of this larger trade war and how it actually ends up affecting the person on the street?
Yeah, I think there is. I think what we're starting to see is what I think is inbound based on what we're seeing in the expansion of the trade war, and I think China digging in a lot of ways, or in a number of ways, is what I've called China. We're a COVID economics 2.0, right? So we've got, in COVID we had supply chain disruptions. Check, we got supply chain disruptions. We had very substantial U.S. fiscal deficits, over $2 trillion a year. Check, we've got that now. A slowing economy sequentially. Check. And then you've got, Treasury market volatility suppression. Check, right? So the one way or another, they're trying to inject dollar liquidity to keep the Treasury market from dysfunctioning, into goods shortages, into big deficits. We know how this plays out. This plays out in transitory inflation, right? Which was, peaked at 8% and lasted for 2 years. So 8% officially, by the way, in the US, not even unofficially.
Mm-hmm.
So I think we are on a path of this that is a modified version of the economic outcome we saw during COVID. And we know what we got during those times. So I do think we're going to get to a point where people are going to be, if inflation was a problem the first time politically, I don't see why it won't be a problem the second time.
Right. But when we add this idea of inflation versus interest rates resulting in let's say a negative real rate, can this have, in a sense, a positive effect, let's say, on the size of the deficit because of this negative real rate?
Possibly. It depends on, because that's ultimately what you need, to your point, which is you need a sustained period of very negative real rate. So if we can get inflation at, I'm just going to pick a round number because it's easy, 10. Mm-hmm. Run inflation at 10, and we've got, the Treasury not letting 10-year Treasury yields go over 4.5. And we hold that there for some period of time, it's very stimulative. The question within that will be, what do corporate profits look like? What does employment look like? What those types of things. But from a strict top-down academic sense, that's what you need. You need significantly negative real rates. So if we can keep GDP growing, if nominal GDP grows as a result of this, then that's kind of what you need, as long as you can, that'll work. But if nominal GDP really slows, while you have inflation, which is hard to do, but that's kind of the $64,000 question. And I think ultimately, it's a very I think ultimately they will be able to do that because again, you go back to the COVID 2.0 economics, right? Of we are suppressing Treasury market volatility. We are not going to let the Treasury market reflect that higher inflation one way or another. It is a move in that direction. It would actually conceivably, it be a path to generate that kind of an outcome.
Mm-hmm. So, Luke, you had mentioned this idea of the move index and the movement and gyrations within the Treasury market. And you've also written about what you've called the Bessent put. And so far, has it been a case of the new boss ends up being the same as the old boss?
It has, in my opinion. People have been saying, where's the best input? Where's the best input? And I think 2-3 weeks ago, we found exactly where it was. And it's exactly where it was under Yellen, which was soon as Treasury market volatility hit 135 on the upside, as measured by the MOVE index, in came the jawboning, in came the promises we'll do bigger Treasury buybacks, in came the delay on the trade stuff. So there was an immediate response. And stock markets reacted to that, and we can see it very clearly. So it's been 135 on the upside on the MOVE index is where the best input is. But it's, I think, very important for investors to know they're not targeting the S&P, they're targeting Treasury vol, and in particular suppressing Treasury vol, and they will do whatever they need to suppress Treasury vol, and I think they're doing it right now. And that then leads to what we're seeing in the gold market, what we're seeing in the stock market in the last couple of weeks, what we're seeing in Bitcoin market in the last several weeks. And I think it's a very important takeaway is if Bessent's going to suppress Treasury vol, then that's an accelerant to COVID 2.0 economics, which is, the financial asset markets are going to be ripping again while the real economy is experiencing, shortages and supply chain disruptions, et cetera.
Mm-hmm. Have we seen any change in appetite for Treasury auctions yet since Trump has taken office? Or is this, because of let's say the lag in reporting, is this a very opaque market to be able to kind of pull those kinds of clues or answers from?
Well, I think you can see, they report the foreign holdings on a 6-week lag or something. And it's a bit of a Rorschach test. People say, oh, look, holdings, demand for foreign treasuries is strong. And yes, and if you look, it's actually all T-bills. And in fact, the monthly buying of U.S. Treasury bonds now is in the second quarter running at $30 to $40 billion a month. That is the same Treasury buying monthly rate that foreigners were buying 10 years ago in the fourth quarter of 2015. The difference was that the federal debt was 18 trillion then, and it's 36 trillion and change now. And the difference in terms of the uptick over 10 years, when we take a snapshot of now, last quarter versus fourth quarter of 15, it's all T-bills. So foreigners are buying. It's all T-bills, which means the most powerful government in the world is essentially financing itself in the sovereign equivalent of overnight payday loans, which is fine. It is also highly stimulative relative to trying to term out that debt. And I think importantly, there's a huge signal, which is it's another case where what Bessent spent all of 2024 talking about, that's too strong. What Bessent mentioned multiple times in 2024, where he was criticizing Yellen for not terming out the debt. His first quarterly refunding announcement, or QRA, at the end of January, he'd been in office like 10 days. Okay. He kept Yellen's issuance calendar. Well, the one last week, he now has another 3 months. Guess what he did? He kept Yellen's issuance calendar again. And the U.S. Treasury began doing buybacks in May of 2024 under Yellen. Since then, so it's been 11 months, they've done $169 billion in buybacks. The last 3 months, they've done $75 billion of that $169 billion. So over half had been done in the last 3 months. So he was very critical of Yellen for not terming out the debt, yet he hasn't termed out the debt. He's accelerated the pace of Treasury buybacks, which is just a swap. It's just managing liquidity. It's yield curve control light. And if you don't like that term, call up a chart of the long-term U.S. Treasury bond future and look at what the price has done since Yellen started buybacks. It's had a floor under it, which is yield curve control light. And then people say, well, oh, foreigners, they're still buying lots of treasuries. They are. They're buying them all in the bill market, which no problem. Well, that's exactly where I own a lot of bills too. I wouldn't buy 10-year. For my duration, I own gold and Bitcoin. For my short term, I own bills. And I think foreigners, everyone around the world is kind of looking at what they're seeing going, everything Trump's saying is basically we're going to weaken the dollar a bunch. If they achieve all their goals, they will have weakened the dollar a bunch. And, you're not very smart if you're buying, that's too harsh too. It's not a good way to make money to buy, 10 and 20 and 30-year Treasury bonds ahead of what could be a pretty pronounced dollar weakness if the Trump administration does what it wants to do. So, your foreigners are still there. They're buying it at the front end, and Bessent is fishing where the fish are, which is, keeping Yellen's issuance at the front end, which is, again, when we overlay it with supply chain disruptions and Treasury volatility, so, the suppression of which keeping issuance at the front end is part, it's inflationary.
Mm-hmm. Well, it's interesting that you mentioned that, the idea of holding treasuries as well. And, we recently saw Warren Buffett announce his retirement. And I thought his comments about, holding dollars or holding a currency that is going to be printed one way or another, yet Berkshire Hathaway's $350 billion cash reserve stands in exact opposition to what he's saying. So how do we make heads or tails of what he actually said versus his actions?
Yeah, I thought it was an interesting headline when he said there are things that could happen in the U.S. that would make us not want to own, make us want to own other currencies. And, this too was kind of a Rorschach test, right? Where, some people are like, oh, look, Warren Buffett is, and I think that's too strong. And other people said, oh, it's just if they do an acquisition in Europe, then maybe, but that's also, I think, ignoring the elephant in the room, which is, Warren Buffett's Captain America. He's been like, invest here, it's the best. So he may have caveated it by saying, well, if we buy something in Europe, why would you buy something in Europe? You're Captain America. You've been telling us for 30 years, all I need is, Coca-Cola and, McDonald's burgers. And now all of a sudden, maybe you'll make an acquisition somewhere else. So I think the truth is in between those two extremes of nothing's changed and, oh my God, the world's over, or it's over for the dollar. I think what has gotten a lot less press than it should, although I've seen some, I think some very smart and astute commenters highlighting it, is in 2003 or 4, Buffett wrote in the annual report for Berkshire Hathaway, he laid out literally Trump's economic plan. The trade is good. But trade, when you settle in the financial assets of your country, is bad, because what it ends up happening is you end up being a sharecropper, his words, not mine, in your own country, where foreigners own your assets, your equities, and that's not good. And he warned about it in 03, 04, and that's literally what we've seen happen, which is free trade is good, but if you're going to buy widgets from China and then sell them shares of Apple in return, pretty soon they're going to control Apple and critical semiconductor technologies and right. So and the reason that Chinese are buying equities and not treasuries is for what we just laid out, which is it's probably not a really good idea to buy a bunch of long dated bonds when you can see when sixth grade math shows you the Americans have to devalue at some point and are actively talking about it now. So when Buffett says what he says in that context. And then, yes, he owns $350 billion, but it's all in bills. That's, again, everyone sort of is, the elephant in the room that no one's, the foreigners are buying lots of dollars, all in bills. They don't trust the Americans. And Buffett's buying lots of dollars, all in bills. They don't trust the dollar, and Buffett, I don't know, for whatever, he will never or can't say own some gold. But that was, to me, what we saw Buffett say last week and was as close as we'll ever get to seeing Buffett say own some gold. Mm-hmm. And oh, by the way, that's how you balance trade, right? It's just, you can't balance trade. The more you sell dollar assets to settle your deficits, the stronger and stronger the dollar will get until finally you get where we are, which is we can't even make the weapons to fight a small proxy war without China's factories. And that's not a real smart position to be in either. So at any rate, I've kind of rambled here, but I think ultimately what Buffett's comments are, I don't think they are inconsistent with that. I think it's ultimately, look, he owns bills. He can't find assets that he finds particularly attractive. Part of the reason he can't find assets that are particularly attractive is because the Chinese have bid them all up because the Chinese don't want treasuries. So, basically long-term treasuries are not a good deal. The Chinese are buying assets that has bid up the value of U.S. stocks. That makes them unattractive to Buffett. Buffett doesn't want to own long-term treasuries either, so he's buying bills, as are foreigners. And guess who's buying long-term treasuries? The same people that were buying houses in 2005 and the same people that were buying sockpuppet.com in 1999 and 2000. It's American retail. 75% of the auctions last quarter per the QRA were bought by investment funds. That's a proxy for mom and pop. It's retail in the U.S. 75% of 7, 10, 20, and 30-year bonds. Buffett's saying, I'll buy bills. And, there's things the Americans could do to make the dollar not so hot. And the Chinese are like, hey, sold to you, mom and pop. You give us Apple and you take the treasury bonds. That's what we're watching happen in real time.
Luke, does that end up kind of being part of this passive investment kind of movement? As you said, it's these investment funds that are buying that stuff just because that's, let's say, part of their mandate?
I suspect that's probably a big part of it, yeah. That, hey, everyone needs to be in the 60-40 portfolio. And for most boomers, it's probably a 40-60 or 30-70, in terms of equities bonds. And so, yeah, what do they own? Hey, look at this nice, juicy 4.3% yield on the 10-year. And it's been 50 years, 40 years since anyone's had to worry about inflation in any sustained basis. And of course, I should put inflation in quotes because we've had inflation the whole time. We've just sort of underreported it, et cetera, et cetera. Yeah, I think it's I think that's a part of what's happening. And so, boomers are buying a bunch of bonds and Chinese are, up until recently, buying a bunch of U.S. equities and increasing control of corporate America. Buffett's can't find any good deals because Chinese and passive are bidding up equities mindlessly as we run these big deficits, and he's not buying the long-term bonds because he knows how this goes. I mean, he in 2012 in the Berkshire Hathaway report said, quote, long-term treasuries should come with a warning label. That was 2012.
Yeah.
Take a look at the chart of the long bonds since 2012. It ran a bit further, but we're back to 2000 levels now. So yeah, I think it's all kind of part of that same picture.
So, Luke, you and I were kind of lamenting this idea as we're, having a little discussion before we hit record here this morning of this morass of news that we've had to kind of navigate. It's crazy. For myself, I told you that I remember the first Trump presidency where I felt exhausted like 2 years in because of the news flow. And now it seems 10 times worse. And, I like this idea of let's say the first section of this interview, having explored all of the micro things that are happening between tariffs and everything. And you recently wrote an article that I think does a really good job of picking out, let's say, 3 of these events that have happened that are seemingly unrelated, that relate back to this 50,000 foot view of what's really going on here, or what could really be going on. So to illustrate that point of zooming out and getting this bigger perspective, these three events were JD Vance's Easter Sunday meeting with the Pope, Trump's tweet about he who owns the gold makes the rules, and China's push to further accelerate gold's convertibility for yuan. So taken together, what do these three, micro events end up meaning in the bigger picture?
Yeah, so to me, the big deal to be had, the United States has been too hollowed out by the dollar system. In other words, we have to run the deficits, supply the dollars to the world. They buy our financial assets, what we were just talking about. And the problem is we can no longer credibly project conventional military power in any real way. That was made empirically clear in Ukraine. We were outproduced 4-1 by the Russians. That's not my words. That's the Secretary General of NATO. So there's, I think, the combination of the U.S. military, DoD, and corporate America increasingly in the second Trump term, because they see they are losing to China in parts of the world, or see clear to how they could in coming years. There is a recognition that the U.S. needs to change the global monetary system. They need to change the flows of capital. And so I think that is a matter of national security for the U.S. The other side of the coin is the Chinese need to be able to buy commodities in their own currency, or else they're going to have a Southeast Asia-like currency crisis, late 90s Southeast Asia currency crisis. These are immovable opposite forces. The Nash equilibrium, the way you split the baby to be biblical about it, is you settle trade in a neutral reserve asset, right? So the Americans shift to a system where the American deficits are settled in a net settled in gold that floats in all currencies. The Chinese have the ability to buy oil and gas in their own currency, and it is net settled in gold. In other words, they pay in yuan. The yuan are recycled into the Chinese economy for Chinese goods, and then any net left over is settled in gold. So the neutral reserve asset is the way you settle this without World War III, literally. And so to me, that's the big deal to be had. So when we then layer on, and why that deal needs to be had, when we layer on the three things you highlighted there, I didn't see initially that Vance had met with the Pope. That was Easter Sunday. Trump tweets out while he was very sick. He died the next day. Trump had tweeted out Easter Sunday night, "He who holds the gold makes the rules." That's the golden rule of negotiating, which was interesting, but not overtly so to me. Mm-hmm. Next morning, my wife goes, "Hey, did you see JD Vance met with the Pope yesterday?" And my spidey sense went off the chart. It was like, I was hit by a lightning bolt. And I said, "What'd you say?" He met with the Pope yesterday. And, later the Pope had died. And the reason that touched off my spidey sense, and I don't do a good job in that report highlighting it, and I touched on it about a week earlier in a different report, but I was told that my wife and I were in Italy last year, and we did a detailed tour of the Vatican, among other things. And I was told that for centuries, one of the biggest gold custodians in the world has been the Vatican. They've acted as a BIS, Bank of International Settlements, gold custodian for centuries. Obvious reasons: trusted, neutral. No one's going to invade the Vatican. No one's going to get the gold. So now all of a sudden we have JD Vance meeting with a very sick Pope on Easter Sunday, which is the holiest of Christian holidays. And then that night, Trump saying, "Hey, he who holds the gold make the rules." And then we have the Chinese that week, 2 days later, in successive days, announce increasing purchases of state enterprises going to do more business in yuan, being encouraged by the PBOC, and then setting up a much broader array of warehouses for the Shanghai Gold Exchange to basically, not even basically, to internationalize the yuan faster is basically what the article says. And this is on top of what the IMF highlighted a year or two ago, that offshore renminbi clearing banks are already in place in every major gold trading and processing hub: London, Switzerland, Dubai, Singapore, South Africa. So there's already an infrastructure in place there in theory, where you've got, but they're making it more explicit. And so, to my eyes, especially coming on the heels of the delay of the tariffs, especially coming on the revelation that Chinese finance officials had been smuggled into the White House through the Treasury building. Someone got nobody in America reported on it, but a friend of mine on X highlighted that it was South Korean media. Someone got a picture of them, and they're like, "Hey, here's people say they're not talking, but these are Chinese finance ministry officials going into this building in Treasury, which is right next to the White House." So they were talking. So it doesn't prove anything, but it is a heck of a daisy chain of circumstantial evidence. And so what I think is en route is this grand deal where we're going to see, where gold is going to have some role as a neutral reserve asset going forward that satisfies the Chinese need to be able to buy commodities in its own currency, or else it will collapse. The American need to reshore, which requires a weaker dollar. And if you're settling more trade through a neutral reserve asset like gold, what that's ultimately going to do is force currencies to trade more on balance of payments and less on interest rates. And on a balance of payments basis, the dollar is by far and away the dirtiest dirty shirt. We run the biggest current account deficits of anybody because we had to supply the dollars for everyone. So basically, gold will be running the deficits from now on in that system. We'll be balancing things out. And what does that look like? Yuan's at 24,000 yuan gold right now. Dollars at $3,400 gold. In that system, you would see something like yuan gold goes to 30,000 yuan, but the dollar goes to $7,500 gold or $10,000 gold. At $7,500 gold, while it's at 30,000 in yuan, 30,000 divided by 7,500 is 4. Yuan goes to 4 on the dollar. Or, it's 30,000, 10,000, it's 3 versus 7.2 today. Or if you want, you take gold to 6,000 and 30,000. The yuan goes to 5. But the point is that inherent in all these discussions, we want a weaker dollar against the yuan. The Chinese want a strong, the Chinese are probably sitting there going, we're not going to do, and forget about probably, you can read chapter and verse, Chinese officials have said over and over the last 15 years, we are not going to do what the Japanese did, which was cut our own throats because the Americans told us to, by strengthening our currency. And so this would be a compensated revaluation for the Chinese, right? J.D. Vance today is talking about the Chinese need to consume more. Great. This is Wednesday, the 7th of May. J.D. Vance just said that. Well, gold goes up in yuan terms. Gold goes up a lot in dollar terms. And now all of a sudden, you're going to be recapping Chinese consumers, banks, the sovereign balance sheet. You can consume more. You can stimulate more without blowing up the currency. Similarly, through the gold pivot, the dollar is going to weaken meaningfully. We actually can compete again. There's actually going to be a balance going forward, because if we run too big of deficits and the Chinese run too big of surpluses, gold will go down in yuan terms. And if we run too big of deficits, gold will run away. It's a neutral reserve asset system that, to my eyes, appears to possibly be being set up, which, that's the good outcome. That's the happy outcome. Because the unhappy outcome is World War III.
Yeah, I mean, again, there's so many clues that, as you perfectly mentioned, don't necessarily prove anything, But I think another interesting, what would it be, breadcrumb in this daisy chain, as you put it, Luke, is this idea that, we've already seen gold go up 20% this year. We had the big LBMA issues of trying to get physical delivery out of London, mostly into the US. Is the US still importing massive amounts of physical gold? And who has the appetite to be bringing this amount of gold into the US?
Yeah, to me, that's another clue in this whole thing, which is we've seen year to date, I think it's well over 2,000 tons. Somebody has brought in year to date so much gold that the Atlanta Fed started exempting gold imports from their economic outlook.
Yeah.
And so they've been running at about a 2% of GDP clip year to date. Well, that's like $540 billion a year in gold. At current prices, that's like 5,400 tons of gold. That's, annualized 5,400 tons of gold. That compares to 8,000 tons, 8,100 tons the U.S. official reserves has. That's a massive amount of gold. Who's bringing that in? Number one is question one, but maybe even more important than question one is who's allowed to bring that in without getting a tap on the shoulder? And that to me is the question. Like no one's even asking who's bringing it in the mainstream economics media because I don't know. Nobody cares about gold, even though it's $540 billion a year import now at an annualized rate. The second question might be more important. Who's being allowed to bring it in? Because look, gold is a political metal. This is not, hey, short-term trader, I'm going to try to get a bunch of in front of me. Look, for years, you can total up all the inventory on the COMEX and you multiply it times the price of gold. And any moderate to big size hedge fund in the world could have showed up for the last 30 years and broken the COMEX like pretty easily without really breaking a sweat. Give us all the gold. Here's your, $1 billion, $2 billion. And now we're going to short squeeze gold to the moon and And given the compensation incentives for all of the world's hedge funds to do that, all they needed to do was buy up a relatively limited amount of gold at the COMEX, squeeze it higher, and they make 20% of some really big number as, they break the bank like George Soros did to the pound. So why didn't they? Why has nobody over the last 30 years, 40 years, never attempted to break the COMEX? It's all right there out there in the open. And so your only two possible explanations to that are all these hedge funds who get paid 20% of every profit dollar they make never thought of it, or they know they can't. It's political. And I'll give you one last clue, which tells you the answer, which is, as of at least a few years ago, I was told most Wall Street prime brokerage contracts specifically preclude hedge funds from taking physical delivery of gold. Mm-hmm. In a lot of cases. I've had multiple different sources tell me that was the case. I don't know if it still is, so huge caveat. But that would tell you, right? Like, it's a political metal. There's something else going on there, which I give by way of background because it helps us inform and back into who could be bringing in all this gold into the United States. It's a case of the dog that doesn't bark, right? Somebody bringing in that much gold is sort of threatening the LBMA at some level. That is a currency related move, a derivative currency related move. You don't get to do that unless you're going to get a tap on the shoulder if you're doing that out of turn. So somebody is doing that in turn. So to me, the message of this massive imports of gold is that it is probably somebody. It's probably somebody related to the U.S. Treasury, whether it's by proxy, blessing, however you want to do it. And we can go back and look at the Hunt brothers when they tried to corner silver, they changed the rules. We can go back to 2020 and look at when we had a similar type of dynamic. The gold couldn't move because of COVID. They changed the rules. They changed the contract terms. Yet that didn't happen this time. It was like, oh, well, it's all coming here because maybe, and then, oh, by the way, the tariffs went through. There were no tariffs on gold. He tariffed an island full of penguins. He tariffed everybody else, but he didn't tariff gold. And yet the gold flows haven't really stopped. So to me, I think it's another really important piece of breadcrumb in all of this when you add it to the others, and especially when you add it to the final, another breadcrumb to it. It's not the final breadcrumb, but when you add another breadcrumb to the trail, which is, look, if the price of gold is bid up enough, Bessent has the ability to instruct Fed to revalue the gold certificates, which creates a TGA deposit of, the amount of tons times the price increase in gold. At 30.
Sorry to interrupt, Luke, but this is exactly where I wanted to go with this. And
perfect.
As silly as it is, to add something that you said earlier about we can't believe something until it's officially denied. Bessent came out specifically and said, we are not thinking about revaluing the asset side of the balance sheet with gold. So, I mean, obviously this is wild speculation and, just pattern recognition as our dumb human brains do. But saying that and being very explicit about saying that is another interesting clue to me. And again, sorry to interrupt, but we could be watching the, let's say, stealthy process of this revaluation of gold on the Treasury's balance sheet, right?
Oh yeah, the podcast in which he said that, right? So I've been talking about this for a while, and he said that on the All In podcast, and I think what he said exactly was, today we are not thinking of revaluing the gold or something like that, or today we are not, I can tell you today we are not revaluing the gold. That's what he said. I can tell you today we are not revaluing the gold. In response, he said, well, I said, we're going to monetize the asset side of the balance sheet for the American people. And all the gold bugs said, oh, he's going to revalue the gold. He said, I can tell you today we are not going to revalue the gold. In my view, number one, today is doing an awful lot of heavy lifting right now. Today he didn't. How about tomorrow? And that goes to the second point, which is the All In podcast. If I would have been the host, I would have said, what do you mean today? How about tomorrow? Mm-hmm. How about next week? How about, are there any circumstances under which you would consider that, Mr. Secretary? And Mr. Secretary, you have access to information we have. Who is bringing in $540 billion a year annualized of gold into this country? Who is that, Mr. Secretary?
All of a sudden.
Yeah, all of a sudden. Mm-hmm. Literally, you are telling us you're focused on the economics of this country, and he is. And we have an import of gold that is literally dropping GDP's calculation by 2% in a $27 trillion economy. Who is it, and why are you allowing that to happen, Mr. Secretary? And they completely missed the ball. I mean, and it's fine because, again, if you're, if you're my age, 5 years older in this country or younger, probably, who am I kidding? If you're 70 or under in this country, you don't care about gold. You wouldn't even think of it. It's useless. All these crazy gold bugs, and I get it. Like, some of the gold bugs are nuts. But there's something happening here. Like, it's almost malpractice as a journalist to just let him off with that. How did you not press him on? Because let's not miss a forest for the trees. The Treasury Secretary of the United States of America has talked about gold 2 or 3 different times, and he's been in office for 3 months. When was the last Treasury Secretary who talked about gold ever publicly, let alone once a month for the first 2 months? I don't remember Yellen ever talking about it. I don't remember Lou, and I don't remember, I don't remember any of them ever. Like, you don't talk about gold, and yet he's talking about gold. So, yeah, I think thou dost protest too much was what today is doing a lot of heavy lifting, and thou dost protest too much, because the math is the math. He's going to have to do it, in my opinion. It's just a question of when.
Well, and it just seems, if we're facing this gigantic deficit, this gigantic debt that keeps just adding up and compounding with the interest rate. It seems irresponsible not to at least market to market rather than holding it on the balance sheet at $42 an ounce, right?
Well, if I'm him, and it goes back to the today point, I wouldn't do it yet, right? Think about talking through what we just talked through, which is, this is, you get one shot, right? This is like M&M, right? You only get one shot to do this right. And everything's okay, right? Things are like, okay, the trade thing, we did have the Treasury disrupted. We've got that calmed down. Great. We don't need to do it yet. Mm-hmm. And if right now it is a lot of money, if he did it today, 3,400 an ounce, I want to say the number is probably just short of $1 trillion. Maybe it's $900 billion. That's a lot. But like at the end of the day, what does that really do for me? Like that's 6 months of deficit, not even, right? Maybe it precludes me from having to issue anything at the long end for 2 years, right? So it would actually support the 10-year Treasury, but like the 10-year Treasury is fine right now, and no one's, I don't need to do it, so I wouldn't do it if I didn't need to do it. And in the meantime, if on the other side he's aware of this trade deal, which gold is going to be a part of, and which implies a much higher price of gold sometime in the next 6 to 12 to 18 months, as gold re-becomes the neutral reserve asset, which means, it's going way higher. Why not get that trade deal done? Let that trade deal happen. Let it bid up gold to some big number, 7,000, 10,000, 15,000, and then do it. And now at that point, look, at $10,000, you're talking about, that's probably from here, every $4,000 is $1 trillion, right? So from here, that's it's $3 trillion. Like that's real money. Wait, every $4,000 is $1 trillion, right? Yeah, every $4,000 is $1 trillion. So yeah, it's even then you're still only talking 2-3 trillion, but at least it's a lot more where you can, you might not need to issue anything, or you're gonna have a lot more freedom to do it at some really big number. 15,000, you're getting closer to, you can buy back a big chunk of the Treasury market, completely recap your balance sheet. So some of this is speculative, but if it was me, I wouldn't do it till I had to do it, and I would let the market bid it up for me. Because that's the other thing, is if he comes out and says, well, we're going to do it at 15, now he's the market. Mm-hmm. He's going to have to, and I've pointed out that he could do this in the past, and people said, well, Luke, he's going to have to be the market. And they're right. When they push back, like he's going to have to be the market, he would. And being the market in gold at 15 when it's trading at 3,300 is going to be tough. But if you let a trade deal push it to 15 for you, that's the market. And now you just, hey, I'm just marking it to market. Great. That's free money to recap the U.S. balance sheet. And oh, by the way, the dollar will have weakened meaningfully in that case, which means growth and inflation are going to be ripping. And you're probably going to need to kind of manage that process using the gold. In other words, there's not going to be a lot of demand for treasuries at significantly negative real rates at the long end. So that would give you a kitty, that would help you manage that process. That's how I've thought about it.
But let's say to incentivize treasuries, and maybe let's just stick with treasuries, to incentivize treasuries at that point, could we see gold certificates as the idea was brought forward by Judy Shelton before? And would that also bring investment into the US over other currencies?
Absolutely could. And that could be a way to do this. I would say at the current price of gold, one of the valuations of gold metrics we look at is the market value of US official gold as a percentage of total foreign treasury outstanding. And today with the run we've had in gold, that percentage is 10%. So foreign held treasuries are 10% collateralized by U.S. official gold at market value. In 1989, when the Berlin Wall came down and we entered our unipolar moment in history, that was 20%. So gold would have to double just to get us back to 1989. The long-term average is 40%. So gold would have to quadruple just to get to there. And if we had an honest-to-goodness dollar crisis like we did in 1980, it was at 135%. So gold would have to go up 13x if we had an honest-to-goodness dollar crisis where And as a practical matter, that's a gold bubble. That's a true gold bubble where literally every foreign creditor could show up with their treasury, say, give us your gold. And we still had 35% of our gold left over if they would have done that. So, our foreign debt was 135% gold collateralized. I don't think we're going to get to that again. Point of bringing that up is that I think Judy Shelton's plan, where you basically have, there's a number of different ways you can structure it, but basically a gold sweetener to lower the coupon, because right now treasuries never have any credit risk; it's all inflation risk, which is interesting. For me, Bessent talked about credit risk on treasuries at the long end yesterday or 2 days ago. I'm not sure what he was talking about, to be honest. I think he meant term premiums and inflation risk, and it's all inflation risk. But the problem is if you add the sweetener at too low a gold price, people are going to demand the gold, and you don't have enough gold at that point. So you've got to price the gold appropriately. So if you assume 40% long-term average, 4x gold from here, $13,000, $14,000 gold. Hey, we will. Would I buy a treasury? Long-term treasury at 2-3%. With a gold sweetener to the tune of, I don't know, 5% or something, valued at 14,000, 10,000, 7,000. Yeah. But if you let the market take it there first, it makes it much easier to do. But I think that there are lots of different ways to use gold to lower borrowing costs for an over-indebted government. Judy Shelton's being a very elegant way of doing that. But it all kind of points to the same thing, which is not at this price. Like, you need a much higher price of gold first. You don't want to be the guy who bids it up, because then you're the market. So how do you do it? You can make it part and parcel to a grand deal in theory. And, people say, well, there's no grand. They're talking. Bessent just said, I'm going to Switzerland. They're talking.
Well, and taking this into account and asking the market to do the heavy lifting of that repricing is also interesting. And I want to understand if it matters who actually does, who is, let's say, more responsible for that repricing. The Shanghai Physical Gold Exchange has kind of taken over a good segment of the pricing of gold. Does it matter if China is the one to do it, if they're benefiting from it on the other side as well as the US?
I think that's right. And I think it also highlights, I think, a really underappreciated point that, again, not a lot of people have noticed, but there's been so much gold brought into the COMEX gold inventories. The COMEX, as of a couple of weeks ago, was a 100% gold collateralized exchange. Mm-hmm. It's now a spot exchange, maybe more spot physical than Shanghai. Why now? And then especially when you look back, Trump's first term in 2020, early 2020, someone started bringing in a bunch of gold then. It got up to about 85%. All of the contracts outstanding, 85% backed by gold. And then he lost the election, and that 85% bled back down to sort of the historical lows under Biden. And now Trump comes in, and somebody brings in tons and tons and tons of gold, and basically, not even basically, de facto collateralizes the COMEX as a spot cash gold exchange, 100% backing of of contracts. Which I think, to your point, to me, what does that mean? If something like this was being discussed or happening, if gold was moving back into the system in that case, that's how you would want. You'd want major cash exchanges on both sides, major physically driven exchanges on both sides. We wouldn't want, this paper nonsense ahead of that. So, yeah, I don't think either side. Not only I don't think would either side really care when you think about it from the Chinese, but the Americans have actually, contra to sort of everything we know on Wall Street over the last 35 years, someone brought in a bunch of gold and put it in COMEX, and it's now a cash-backed exchange, or basically a cash physical exchange.
Luke, it seems like this is maybe one of the most important markets right now is, let's say, cash versus treasuries or bonds. What importance do you think oil has being in the high 50s to act as a ballast one way or the other in this equation as well?
Good question. I don't. So I'll take one of two aspects.
Mhm.
I'll highlight them both because I don't understand what Bessent's trying to do here. Right. So if we want to make America great again and we want to reshore and we want to increase industrial production, oil at 50 to 55 does not work under the current system unless there's some new system on the come where that makes more sense. And there could be, but you're going to see U.S. shale roll over in terms of production. In fact, you had two drillers last night or 2 nights ago come out and say they're aggressively cutting capex. Math doesn't make sense. So U.S. shale production is going to roll over. I don't. So I understand Bessent's point on we got to get oil down because it helps the consumer, which is like a marginal point. It's marginal because it's already low relative to it's the same price versus 5 years ago. And we can see the correlation between oil and the 10-year Treasury yield, right? So the lower oil goes, all else equal, it's taking 10-year Treasuries down. And he said, judge us on this. So maybe he's unifocused on that. And if he's unifocused on that, it's not good for America. It's a penny wise, pound foolish strategy because I don't think he's gonna be able to get 10-year yields to follow oil all the way down, number one. But number two, he's gonna wake up and Putin and Saudi are gonna control the oil market. And I'm not sure that's in our long-term interest. And number three, MBS is going to drink his friggin' milkshake, right? He wants to term out dollar debt, so I want to get oil down. Well, Saudi's break even's 90. Maybe it's 80, 85. But at 55, MBS is going to be issuing dollar bonds until his hands bleed in front of Bessent. And quite honestly, I'd probably be inclined to buy a Saudi dollar bond at a slight yield uptick relative to an American Treasury. So it works, $50 or $55 oil, sub $60 oil works against Bessent's, it works in a very narrow sense of, yes, maybe you'll get yields down in the 10-year. But you ain't gonna be able to issue much there at that price, number one, or at that yield. And number two, doing that is going to force MBS to issue a ton of dollar bonds in front of you. So I'm not even sure it's doing anything for you other than eroding the geopolitical position of the United States long term, because once shale rolls over, it's going to be 3-4 years till it goes back to prior highs, which means Putin and MBS control the oil market, from here till there. So it's on that level ill-advised, and I'm being generous. The flip side of it is, if I wanted to get the dollar down big, I'd hammer oil. And it sounds counterintuitive because you would think normally low oil is strong dollar, but it's not, right? America, think about what's going to happen to America's trade deficit at $50 oil. It's going to it's already at records. And our oil exports are going to go down because our oil production is going to go down, which means our dollar exports are going to go up, right? So part of the way we've supported the dollar over the last 10 years has been the ramp up of U.S. shale production, which has basically reduced the U.S. trade deficit. It's reduced dollar exports because we produce more of our own. We've even exported a little. $50 to $55 oil is going to end U.S. oil exports. It's going to reduce U.S. oil production. It's going to increase U.S. oil imports, which means it's going to increase U.S. dollar exports, which means it's going to crush the dollar. So I can't tell if Bessent is being unily short-term focused, naive about getting oil to 50, 55 because he thinks it'll help him issue bonds at 50 or at 10-year yield at a lower yield. I'd like to think that's not what he's thinking, because he's going to be totally wrong, because MBS is going to drink his milkshake and Putin and Saudi are going to control the oil market for the next 5 years as a result of that plan. The opposite is, as part of some grand deal maybe, and or just to weaken the dollar dramatically, that would do it. The U.S. shale production has been a key leg of dollar strength. And so he's going to kick that out at 50, 55. It's already starting. It's a political question because, Texas is not going to be happy if that's the plan. Like we're going to put a bullet in U.S. shale to weaken the dollar as part of a deal. Like, we'll see how that plays out. So barring what, $50, $55 oil does, look, we know oil's not sustainable below 65. Shale's not sustainable below 65. It has a high decline rate. Permian's the only thing that's actually anywhere near its all-time highs. Everything else is already rolled in the U.S. Niobrara, Bakken, Eagle Ford are the other three biggest basins. They're all well below all-time highs of several years ago. So Permian's like carrying the whole load, and Permian's going to roll over at these prices, in coming quarters. So, all else equal, I think oil stays 65 to 85 because I don't think it's in our strategic interest to have shale really roll over. But if I'm wrong, what I just ran through is about that is what the issue is. He's either trying to get yields down using oil, which is silly in my opinion for the reasons I said, or he's trying to get the dollar down, which is it would work. It's probably also somewhat silly. There's maybe easier ways to do it, but it would be very effective. That's for sure.
Mm-hmm. Seems like another order of operations issue at this point with, all of these externalities wrapped around it.
Yeah, because even think about the dollar weakness side, right? So it's on one level, you get oil weakness, you should get yields down, but you're going to get dollar weakness with it. And in the short run, dollar weakness and 10-year yield have been correlated. You run a chart of the 10-year yield and the dollar, lower the dollar goes up to a point, lower the 10-year yield is going to go. Great. But that's only a finite period of time. He better plug all of the debt into that finite period of time and hope it doesn't raise yields at all, because the reality is on a lag, that weaker dollar is going to increase inflation. And so once that pickup in inflation on a lag happens, what have you achieved? You've got no drop in yields on net, and you've crushed the U.S. shale industry for the next 4 years. Congratulations. Great policy. Nice job, guys. So that's what in a lot of ways, they're trying to thread a needle. This is one of those ways that they're trying to thread a needle. I think they're making it way harder than they need to be. I think they just, devalue it versus gold and freaking buy down the debt and move on. But, political realities are not as easy as I would like them to play out in my mind.
Luke, you mentioned Putin in there as well. How does this entire conflict with, as you mentioned, this price of oil that could incentivize Putin and the Saudis to take over the oil market, does that work in their favor at this point?
It's the opposite side of the same coin, and there's a short-term and a long-term side to it to them too. I mean, all else equal, short-term, it's not good for them. Either one of them. They have Putin's running a war. It's expensive, and MBS has fiscal break evens and that in the $80 to $90 range. There's stuff he wants to do, and those get more expensive. He's gonna have to borrow the money if it stays there. So those aren't good. Balanced off against, I think if the Permian rolls over, Permian's what, 5 million barrels a day, 5.5 million barrels a day? It's like 6% of the world's oil market. Once it rolls, it ain't gonna grow for 3, 4, 5, 6 years and maybe longer without like a super spike in oil. So there's that narrow short term, it isn't good for either one of them, balanced off against, holy cow, the Americans are regifting us the oil market for the next 5 years. Great. That's a huge, strategic gain on their part. So it's the opposite side of the same coin of trying to, try to balance that off.
Look, I know this is obviously a lot of what we focus on, but do you get the sense that the economic, the world of economic plumbing at this juncture is far more important than the big conflicts like Russia, Ukraine, like Taiwan, maybe excluding the Middle East, because that doesn't necessarily seem that it's as related financially to this entire picture. But do you get the sense that this, as you put it earlier, this economic warfare maybe delaying or getting away from World War III is actually diffusing a lot of these conflicts because of the importance of getting the economies and the currencies right at this time?
I think one way of interpreting the events of the last 5 years with Ukraine, 10 years with Ukraine, 15 years, 20 years back to the Iraq War, 25 years to the start of the Euro, has been Anglo-American and Atlanticist interests trying to stop a change to the system. I don't fully agree with that view, but there's a lot of it that I do. What do I mean by that? Euro launches in 1999. To the surprise of everybody at that time, they took 15% of Eurozone reserves and they put it into gold, mark to market quarterly. If there was a time, I've never seen gold as hated as it was in 99. I didn't even like gold. I didn't talk about it. I didn't know anything about it. Nobody was talking about gold in 99. It was, it was Uncle Alan Greenspan and how awesome the dollar in America was. And it was pretty awesome in 99 too, by the way. It surprised everybody. And there's an important message there, right? If the Europeans thought America was so star-spangled awesome, they never would have put 15% of the reserves into gold mark-to-market quarterly. And the mark-to-market quarterly means the more we inflate in Europe, the more gold goes up in euros, and the more the Americans inflate, the more gold goes up in euros, and the more our reserves become de facto gold collateralized. They created an oil currency. That's what they're trying to do, because it's been known forever, dating back to when we were dealing, the Arab oil exporters like gold. They do. And they were creating an oil currency. Fast forward, October 2000, Saddam says he's going to price his oil in euros. Voila. Next thing we know, we have a bunch of Saudis fly some planes into a building and we go and invade Iraq. And we switch the oil pricing back to dollars as part of that whole deal. Okay. So that was sort of step one, I think, of like the Europeans were trying to gain the ability to buy oil in their own currency. And I think at some level, there were other factors involved. In some level, though, I think the Iraq War had something to do with that. There was an aspect of an input to that. I think there were other aspects of it for sure. But I think that was an aspect to it. 2008, Putin, I think even in 2007, he gives a speech in Munich. Most Americans haven't read it. It's really eye-opening. And just, hey, it's sort of like a laundry list of here's the things we don't agree with. And here's the things that you said you would do in your rules-based global order, and you broke your own rules. And 2008, they begin buying gold. The Russians begin reserving gold again. And even in the financial crisis, they keep buying gold. Then we get the proxy war in Ukraine. We get the coup in Ukraine and sanctions and the proxy war, et cetera. Okay. That was right around the time we also learned that Russia had begun selling oil and gas to China in yuan as they were reserving more gold, right? They're basically selling oil outside the dollar. The Chinese are doing what the Europeans were trying to do 15 years prior. In 99, 2000 with Saddam. And so within all this, I look at the thing that Russia has that Iraq didn't is nuclear weapons. And so we weren't going to invade Russia because America has never invaded a country with nuclear weapons. But we might we might get involved in proxy wars. And so I think as I look over the last 5 years in Ukraine, I think Russia is the linchpin in this of trying with China to change this currency system to one of a neutral reserve asset, gold, floats in all currencies, commodities priced in multiple currencies. And Russia was the sponsor. Russia was the center of it over the last 15 to 20 years. And that's why I think what has transpired in Ukraine over the last 3 years has been so important to watch from a monetary perspective. Because if Russia tipped over, that was that. If Russia tipped over, we got someone like Yeltsin back in office where they would resume selling off the commodity assets of Russia to Americans and the Harvard boys, so to speak, at the famous article said, at cheap prices, all in dollars. then we would control China too. China would be the next to tip over because we'd ensure they could only buy commodities in their own currency. And sort of the financial dollar center Anglo-American Atlanticist could control the whole process. Problem is that the US and NATO defense base became a victim of its own success. We've offshored so much of our industrial base to support the dollar. We got outproduced by the Russians 4-1 in Ukraine. That was the Secretary General of NATO. And then 3 months ago, Eric Prince, the former CEO of Blackwater, private military contractor, gave a speech at Hillsdale College where he laid out what happened in Ukraine, changed the nature of warfare and balance of the world in a way probably not seen since Genghis Khan added stirrups to horses, like 600 years ago. And what he was saying is the missiles, the hypersonics, the drones completely shifted the balance of power away from the traditional Mahan doctrine, which was US for the last 100 years and the Brits 200 years before that, of if you control choke points, naval choke points around the world with your Navy, you control the world. And it's worked for 300 years. That's how the world has worked. And what Prince is saying in this speech, and I'd encourage it's online, you can find the speech on YouTube, I'd encourage everyone to look it up, was that the balance of power shifted by virtue of these hypersonics and these drones, which is you sail your deep water blue Navy too close to a choke point now under Mahan doctrine, it's going to get sunk. Not my words, his words. In fact, he said, if we tried to blockade Taiwan, you would end up with a sunk US carrier. This is a guy, Eric Prince at Blackwater. He is an eminent authority on these types of things. The point of this whole long background is that if some portion of the last 25 years of geopolitics, as I just laid them out, have had something to do with attempts by the world centered in Eurasia to move away from the dollar system as defined by dollar monopoly on oil pricing, neutral reserve, gold settlement, and the Americans' response to that process over the last 25 years, then Ukraine's and NATO's loss in Ukraine, the inability of the US to produce in sufficient amounts, to get outproduced, means the US and NATO no longer can credibly project conventional military power against either Russia or China, both of whom want to change the system in the manner described. If that's the case, then the window's open for change. And after Ukraine, where Eric Prince has said, look, like this has changed. This changes the rules. It's a huge shift in balance of power. We're just starting to see the implications of it. There's two moves for the West from there. World War III, which will quickly go nuclear, and we're all dead. Or we sit down and we change the system. And we move it to something that, A, addresses Chinese and Russian concerns, but more importantly, gets us away from a position of not being able to produce our own defense without China, which is the most insane thing in the world. I mean, it's just stupid. It's just strategically stupid. It's stupid. And the way you do that is what we started a ways back, which is you repatriate your gold, you put up tariffs, you shake up the board, you force everyone to sit down, you settle and you work out the terms. You end up settling, using gold as a neutral net settlement asset. Trade bids gold to some much, much bigger number. And then the Americans revalue the gold from 42 to said much bigger number. We buy down our debt or we use it to term out the debt at very long things. And away we go. Just like that, we have moved and reshifted the system to something sustainable that is mostly agreeable to the parties that this is somewhat offensive, that matter, the Americans, the Russians, and the Chinese. Sorry, Europe, you don't matter in this. You've lost that ability. And we have a booming global economy without World War III. Like that is how I see the last 25 years. I think what the monetary changes I think they've played a role in all that. And I think what we're watching is the culmination, the denouement, the ending of like we're coming down to tag ends on this. So it's a super exciting time potentially. So anyway, I've rambled there. I think it answered your question, but I think it's a really interesting question.
Luke, as always, I'm extremely grateful for your rambling. I think that was, I've often been presented with, let's say in particular emails from listeners that say, well, China could dump all of their debt and that would serve to kind of put a bullet in America's head. And I step back and look at this and I just think, well, the incentives aren't aligned for that. Like the idea that is what you think is going to happen, you have to think of how that ends up being priced out, what that does for everybody else. Again, the incentives don't align for that. And I've felt for a long time, I'm happy to be wrong, or I would be unhappy to be wrong about this, but the incentives also aren't seemingly aligned for everybody to just go headlong into World War III. As crazy and wild as we might think all of these current world leaders are of the three powers that really matter at this point, as you said, the incentives don't necessarily align. We've enjoyed a long time of growth, relative peace. And again, this idea going back doesn't seem to me that anybody really needs and or wants to really disturb that in a meaningful way. So I think, despite, as you said, you're rambling, I think all of it makes sense to me especially from a first principles and incentive perspective.
Yeah, because again, it's to me, the Ukraine is the final piece in the puzzle, because Ukraine showed the serious people in America. There are very serious, smart people in the halls of power. And you get the vocal hawks and the chicken hawks. Oh, we need to go to war with China, blah, 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 blah. We need to go to war with Russia, blah, 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 blah. They have no idea what they're talking about, what that actually entails. Mm-hmm. Are you ready for the American grid to be shut down for a year? Do you understand what shutting down the American grid for a year entails? Do you really? If you don't understand what that entails, I'd encourage people to pick up the book 1 Second After by William Forshackton and read. So there are very serious people that understand that. The other thing that I don't think is well understood in markets about that is the context in which all of this is happening, the deep historical context, even further back, which is in the end of World War II, the world faced a choice. Everyone thinks capital is printed from a central bank. It's not. It's not. Eurasian capital, built over centuries, had been destroyed from 1914 to 1945. Gone. That leaves two choices. For all of Eurasia, we live in subsistence, scraping by as we try to live day to day, and with whatever little surplus at the end of every year that we have, we reinvest the next year. And for the next 80 to 100 years, maybe living in poverty, we rebuild from World War II. That was option one. Option two is, for a brief moment in time in the grand scheme of history, we treat debt as an asset. And we move to a system where debt is an asset. And that way, the Americans will hold our debt, and the Americans will produce, and then we'll overtake the Americans, and the Americans will send debt to us. And this debt as an asset concept, which was foreign up till that point, allowed the pull forward so that over the ensuing 10 years, you could restore all of that lost capital. But obviously that was the choice made, because politically no one's going to live in poverty for their lives, because their forebears over the last 40 years had self-immolated. But there's always been understood at the highest levels of power that the debt as an asset experience of post-World War II would come to an end and you would go back to something with a neutral reserve asset, gold, something. It was always known. And we're there. Like that's, you look around when you see that the end of it, once you get to the point, and Yoel Zylstra, head of the BIS in 1980, said, we've had the second oil crisis, we can get through that, but the world will not be able to survive a third oil crisis. The oil exporting countries will not be able to recycle the deficits into foreign debt with any hope of repayment in real terms, oil terms. And the system will crumble and the world will be brought to its knees. And this is where we are. Think about what we're saying. The Americans, the sponsor of the system, the primary reserve asset, cannot make its ends meet without significantly negative real rates. How can somebody who produces oil or produces anything reserve a negative real rate asset? They can't. That's the system. It'll be brought to their knees. They'll impoverish themselves. And similarly, the Americans cannot cut anything. Can't cut rates because you inflate. Can't cut entitlements because politics. Can't cut defense because we're already not doing well there as it starts, as we saw in Ukraine. So we're there. That's the end of the debt and so it's really about negotiating that. But this has always been known at the highest level that you would have to go back. And I think we're seeing that. I think we're seeing that in real time. And it's super exciting because on the other side of it, it's a new golden age. It's a new renaissance. It's a new, all the good. It's not good if you've got your whole net worth in long-term bonds of the United States or other sovereigns. But you know what? Pay attention. Like people are like, well, this will take years. Central banks have been buying gold and not buying treasuries for 12 years now. 12 years. And, okay, 1 year, 2 year, 3 years, maybe it's 12 years. How much more of a signal do you need?
Well, Luke, I think that's a good place to kind of bring this in for a landing. It's been an absolutely excellent discussion with you as always, and I'm extremely, extremely grateful for your time, your insight, your brain here. Of course, for anybody that can or that would like to view more of Luke's work, as well as your, let's say, excellent Twitter stream that highlights a lot of the micro movements that we saw today or that we discussed today. That's all available at Luke Gromen and of course FFTT-LLC.com for your bigger reports and stuff. Luke, is there anything that you'd like to leave our listeners to think about before we wrap up here?
No, I think we've covered a lot of ground. I think ultimately I'm still optimistic. We're going to end up at a really good spot. There's a ton of executional risk to a lot of what we've talked about, and I think there's more volatility to come in that time frame. But I think ultimately we end up at a really good spot, U.S. and globally.
Mm-hmm. Again, Luke, I just want to express my gratitude to you for this conversation and really look forward to the next one.
Thanks, Tom. Thanks for having me back on. It's great to be here.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.